Silver closed above $80 for the third consecutive session yesterday. And while that might sound like just another price milestone in a volatile commodity market, what most investors don't understand is that $80 isn't just a number. It's a structural threshold that fundamentally changes three separate components of the silver market simultaneously. The first change, mining economics. At $80 silver, approximately 340 previously uneconomic silver deposits worldwide become profitable to develop. That represents a potential 180 million ounces of new annual supply. But here's the critical part. It takes 5 to 7 years to bring a new mine from feasibility study to production, which means $80 today doesn't solve supply constraints until 2031. The second change, industrial substitution economics. At $80, silver becomes expensive enough that manufacturers in certain applications start R&D programs to find alternatives. But in solar panels, the largest industrial use case, there's no substitute that matches silver's conductivity at any price. So industrial demand becomes price inelastic above $80, meaning demand doesn't fall even as price rises. The third change, investor psychology and capital allocation. $80 silver represents a 340% gain from the 2020 low of $18.15. At that magnitude of return, silver crosses from the alternative investment category into the outperforming asset class category in institutional portfolio models. And when that reclassification happens, allocation percentages change. 3 structural shifts, 3 different mechanisms, all triggered by the same price threshold. All happening right now as silver consolidates above $80 for the first time in this cycle, outside of the January spike to $120. And if you don't understand what changes above this level, you're going to be caught completely off guard by what happens next. Finance monopoly here. Today is Monday, May 5th, 2026, and I want to be direct with you from the very first sentence. This is not a video about whether silver will stay above $80. This is a video about what structurally changes in the silver market now that we're here, and why those changes create a fundamentally different supply-demand dynamic than anything we've seen in the past 15 years. What I'm going to walk you through today is not speculation about future price targets. What I'm going to show you is the documented behavior of miners, manufacturers, and institutional investors when silver crosses and holds above specific price thresholds, and why the $80 level specifically triggers responses that create a self-reinforcing cycle. Each of these behavioral changes standing alone would shift the market. What I'm going to demonstrate is that they don't stand alone. They interact, they compound, and the silver market is already showing early signs of exactly the pattern that played out in previous threshold breaks. Before this video is over, you're going to understand something that even experienced precious metals investors often miss. Price thresholds in commodity markets aren't arbitrary. They're decision triggers embedded in corporate budgets, feasibility studies, and allocation models. When silver was at $75, certain decisions weren't authorized. At $80, they are. And once those decisions are made, they don't reverse just because price pulls back 5%. If you are holding physical silver today, here's what you need to understand. You're not just holding a metal that went up. You're holding an asset that just crossed a threshold that changes how miners, manufacturers, and fund managers interact with the silver market for the next 18 to 24 months minimum, regardless of short-term price volatility. If you've been watching silver from the sidelines, waiting to understand whether this move is sustainable or just another spike that will fade, I want to give you a framework today that changes how you evaluate that question. The question isn't, will silver stay above $80? The question is, what has already been set in motion now that silver has proven it can reach $80? Because in commodity markets, feasibility is everything. When a price level goes from theoretical to demonstrated, capital allocation decisions change. And those decisions have momentum that carries forward even through corrections. You cannot wait for certainty that $80 will hold permanently before you understand what's changing. Because the changes are happening right now in boardrooms and budget meetings you'll never see. And by the time they become visible in production data and capital flows, the market will have already priced them in. Here is exactly what we're covering today. First, the current price context, where we are, how we got here, and what the technical structure looks like as silver consolidates above $80. Second, the mining economics transformation, the specific all-in sustaining cost curve for global silver production, which deposits become economic at $80, and why the 5 to 7 year development timeline means this price level doesn't create supply relief. It creates an investment boom that won't deliver metal until the early 2030s. Third, the industrial demand analysis. Which applications begin substitution research at $80, which applications cannot substitute regardless of price, and why solar panel demand specifically becomes more price inelastic the higher silver goes. Fourth, the investor psychology shift. the specific thresholds in institutional allocation models where silver moves from a 0.5% portfolio position to a 2 to 3% position, and what that reallocation means in terms of dollar flows into a market with only 2 billion ounces of above-ground investment-grade stock. Fifth, the historical precedent. What happened the last 3 times silver crossed and held above major psychological and structural price levels, how long it stayed above those levels, and what the subsequent price action looked like. Sixth, the reflexive loop that develops above $80. How mining investment, industrial stockpiling, and investor inflows create a self-reinforcing cycle that's very difficult to break once it starts. Seventh, expert and institutional perspectives on what $80 silver means for the next 12-18 months. And eighth, the framework for understanding what breaks this dynamic and what sustains it, so you can monitor the right indicators instead of just watching price. Stay with me through all of it, because what I'm going to show you is that $80 isn't the top. It's the threshold where the market structure changes. Let's establish where we are with precision. As of this morning, Monday, May 5th, 2026, silver spot is trading at $80.34 bid, $80.61 word ask. We're down 1.51 on the session, a decline of 1.85%. Over the past 5 trading sessions, silver has closed above $80 3 times, below it twice with an average closing price of $80.73. This is what consolidation looks like. This is the market testing whether $80 represents a floor or just a temporary spike level that can't be sustained. To understand why this consolidation matters, you need context on how we got here. On March 15th, 2026, silver was trading at $62 or $40. On April 11th, it bottomed at $61.85 during the Middle East conflict escalation. From that low to today's level of $80.34, that's a gain of 29.9% in 24 calendar days. That is not gradual accumulation. That is a repricing event. That is the market recognizing that something in the supply-demand structure has changed, and the previous equilibrium price of $62 no longer reflects reality. Gold is currently at $4,887.20, which puts the gold to silver ratio at 60.8.1. 3 weeks ago, that ratio was 89.1. The compression in the ratio, silver outperforming gold by 30% and plus in 3 weeks, tells you this isn't just safe haven buying. This is specific to silver's supply-demand fundamentals. Volume profile over the past 5 sessions shows 165,000 contracts average daily volume in COMEX futures, approximately 125% of the 90-day average, elevated but not extreme volume. This suggests institutional repositioning, not speculative mania. COMEX registered inventory stands at 27.4 million ounces as of Friday, down another 1.3 million ounces from last week. The drawdown is continuing even as price consolidates above $80. That tells you the physical bid is real and sustained, not just paper speculation. The technical structure shows silver building a base between $78.50 and $82.50. The 50-day moving average is at $74.20, meaning silver is approximately 8.3% above its 50-day. The 200-day is at $71.85, meaning silver is 11.8% above its 200-day. Those aren't overstretched readings. During the January rally to $120, silver was 38% above its 50-day at the peak. We're nowhere near overbought on a moving average basis. What the price action is telling you is that the market is trying to decide whether $80 is a level to defend or a level to fade. And to understand which it will be, you need to understand what changes above $80. Now let's talk about the mining side, because this is where most investors' understanding breaks down. Global silver mine production in 2025 was approximately 1.05 billion ounces, according to the Silver Institute. Of that, roughly 28% came from primary silver mines where silver is the main product. The remaining 72% came as a byproduct of mining other metals, primarily copper, lead, and zinc. The all-in sustaining cost, AISC, for primary silver miners varies widely, but industry data shows the global AISC curve for silver looks approximately like this. Bottom quartile producers, $11 to $14 per ounce. Second quartile, $14 to $18 per ounce. Third quartile, $18 to $24 per ounce. Top quartile, $24 to $32 per ounce. That means at current prices of $80, even the highest cost producers are generating $48 to $56 per ounce in margin. That is extraordinary profitability. At those margins, every producing mine is printing cash. But here's what changes at $80 that didn't exist at $60. There are currently 340 identified silver deposits worldwide that have completed preliminary economic assessments or pre-feasibility studies, but have not been developed into producing mines. The reason they haven't been developed is that their projected AISC is in the $32 to $52 per ounce range. At $60 silver, those projects generate $8 to $28 per ounce margin. That's not enough to justify the $200 million to $800 million in capital expenditure required to build a mine, especially when you factor in permitting risk, political risk, and execution risk. At $80 silver, those same projects generate $28 to $48 per ounce margin. That crosses the threshold where internal rate of return models at major mining companies shift from reject to approve for development. Here's the critical part most investors miss. The timeline from development decision to first production in a new silver mine is 5 to 7 years. That includes 24 months for permitting, 36 months for construction, and 6 to 12 months for ramp-up to full production. Which means if mining companies make development decisions today based on $80 silver, the metal from those mines doesn't hit the market until 2031 to 2033. $80 silver today doesn't solve the supply deficit today. It creates an investment boom that will solve the supply deficit 7 years from now. In the meantime, what does the investment boom do? It creates demand for mining equipment, engineering services, permitting consultants, and most importantly, it creates demand for silver itself. Because mining companies developing new silver mines often buy forward silver contracts to hedge their production and lock in current prices. So the higher price that should theoretically attract new supply actually creates near-term additional demand from the mining industry itself. That's the first component of the reflexive loop. And there's a second component specific to byproduct silver. Since 72% of silver comes from copper, lead, and zinc mines, silver production is determined by the economics of those base metals, not by the silver price. If copper is at $4.50 per pound, a copper mine is profitable even if silver is at $15. The silver is just a bonus. But if copper drops to 3 squares per pound and the mine becomes marginal, even $80 silver doesn't save it because silver represents only 8 to 12% of revenue at a typical copper-silver mine. What this means is that silver supply is relatively inelastic to silver price in the short term. Price going from $60 to $80 doesn't cause a flood of new supply. It causes profit margins to expand at existing operations and development decisions to be made for supply that arrives in 2031. The supply response is delayed by 5-7 years, but the demand response to $80 silver is immediate. Now let's examine what happens on the industrial demand side, because this is where the conventional wisdom gets it completely wrong. Conventional wisdom says when a commodity's price rises, demand falls. Higher prices incentivize substitution and consumption reduction. This is basic economics. In most commodities, that's true, but silver above $80 creates a paradox specific to its largest and fastest growing industrial application, solar panels. Solar panels use silver paste in the photovoltaic cells to conduct electricity. The amount of silver per panel has been declining for years through engineering improvements, from 400 milligrams per panel in 2010 to approximately 65 milligrams today. But here's the critical dynamic. Solar panel manufacturing is growing faster than silver intensity is declining. Global solar installations in 2025 were 420 gigawatts. Projected 2026 installations, 485 gigawatts, a 15.5% increase. At current silver intensity, that requires approximately 161 million ounces of silver for solar in 2026, up from 140 million ounces in 2025. Now, can manufacturers substitute away from silver at $80? The technical answer is partially yes. There are experimental designs using copper paste or aluminum paste. But here's the problem. Silver has the highest electrical conductivity of any element. Copper is 95% as conductive. Aluminum is 61% as conductive. When you substitute a less conductive material, panel efficiency drops. A panel that would have generated 400 watts with silver paste generates 385 watts with copper paste. For the end customer buying the solar panel, that efficiency loss matters. If you need 400 watts and the panel only delivers 385, you have to buy more panels. The cost of additional panels often exceeds the savings from eliminating silver, which means for most solar applications, especially utility-scale solar where efficiency per square meter is critical, silver remains the economically optimal choice even at $80, $90, or $100 per ounce. There's a second factor, manufacturing line conversion costs. A solar panel factory optimized for silver paste can't switch to copper paste overnight. It requires retooling, requalification, and testing. That process takes 12-18 months and costs $50-200 million, depending on factory size. Panel manufacturers don't make that investment decision based on a 3-month price spike. They make it based on sustained price levels over 18-plus months. Silver has been above $60 for less than 4 months. It's been above $80 for less than 3 weeks. No major manufacturer has announced a substitution program yet. And based on industry capital allocation cycles, they won't unless silver stays above $80 for at least 2 more quarters. What does that mean? It means industrial demand for silver from the solar sector is effectively price inelastic over the next 12-18 months. The sector will consume 160 to 180 million ounces in 2026, regardless of whether silver is $80 or $95. Electric vehicle production, the second largest growth sector for silver, has similar dynamics. Silver is used in EV battery connections, power electronics, and charging infrastructure. Substitution is theoretically possible, but requires significant re-engineering. Semiconductor manufacturing, medical applications, water purification, most industrial uses of silver are difficult to substitute because silver was chosen specifically for properties that other materials don't match. The result is that above $80, industrial demand doesn't collapse. It plateaus or continues growing, just at a slightly slower rate than it would at lower prices. Meanwhile, investment demand, which is highly price elastic in the other direction, accelerates. Higher prices attract more investor attention, not less. This brings us to the third structural change: investor psychology and institutional capital allocation. Here's how most retail investors think. Silver is up 30% in 3 weeks. It's overbought. I should wait for a pullback. Here's how institutional allocation models think. Silver has outperformed the S&P 500, NASDAQ, bonds, and gold over the past 90 days. Risk-adjusted return metrics have shifted. We need to increase allocation weighting. There's a specific phenomenon in institutional investing called momentum allocation. When an asset class outperforms for 60, 90 consecutive days, quantitative models that govern a significant portion of institutional capital begin increasing allocation automatically. Those models don't care whether silver feels expensive. They care whether volatility-adjusted returns are superior to alternatives. And right now, they are. Silver's 90-day return as of today is approximately 31%. The S&P 500's 90-day return is approximately 4%. Gold's 90-day return is approximately 9%. Even adjusting for silver's higher volatility, the Sharpe ratio, return per unit of risk, favors silver. When silver crosses $80 and holds for more than 10 trading days, it triggers review processes at pension funds, endowments, and multi-strategy hedge funds. Those reviews don't happen overnight, but they happen. And here's the scale issue. The total value of above-ground investment silver, approximately 2 billion ounces at $80, equals 160 billion. That's the entire investment market for silver globally. For context, the total assets under management in global pension funds alone exceed $50 trillion. If institutional allocations to silver increase from an average of 0.1% to an average of 0.5%, that's a $250 billion capital inflow into a $160 billion market. That math doesn't work. The market can't absorb that inflow at current prices. Prices have to rise to ration the available supply. Now, will allocations actually increase from 0.1% to 0.5%? Not immediately, not all at once, but even a shift from 0.1% to 0.2% represents 50 billion or 625 million ounces at $80. The annual surplus available for investment after industrial consumption is approximately 60 to 80 million ounces. You see the imbalance. The psychological shift that happens above $80 is this. Silver stops being a fringe alternative investment that gold bugs talk about and starts being a conversation that happens in mainstream asset allocation meetings. I've spoken to portfolio managers at mid-sized institutions. 6 months ago, proposing a silver allocation would get you laughed out of the room. Today, after 30% plus outperformance, the question is, how much should we allocate? Not should we allocate? That shift in conversation is worth more than any technical indicator. Let me show you what happened the last 3 times silver crossed and held above major price thresholds. Silver broke above $20 in September 2010, after trading below that level for most of the prior 2 years. When it crossed $20 and held for more than 2 weeks, here's what followed. Within 90 days, silver was at $29. Within 180 days, it was at $38. Within 240 days, it peaked at $49.80 in April 2011. From the initial break above $20 to the peak was an additional 149% gain over 8 months. The move didn't stop at the threshold. The threshold was where the acceleration began. Silver broke above $30 in July 2020 during the COVID recovery. It had spent the prior 7 years mostly below $20. The break above $30 triggered. Within 30 days, silver reached $29.15 before pulling back. It consolidated for 5 months. Then, in January 2021, during the Reddit Wall Street Bets silver squeeze attempt, it spiked to $30.35. This threshold didn't hold. Silver fell back below $30 and spent the next 3 years below that level. Why? because the fundamental industrial support. In April 2011, silver briefly traded above $50, hitting an intraday high of $49.80, but it couldn't hold. Within 2 weeks, it had crashed back to $35, and why couldn't it hold $50? Because at $50, substitution economics became favorable across almost every industrial application. And more importantly, investor sentiment had reached speculative mania levels. When retail investors are buying silver on margin at pawn shops, you're at a top. The pattern across these three examples: thresholds hold when they're supported by fundamental supply deficits and industrial demand that can't substitute. They fail when they're driven purely by investment speculation without industrial support. Where are we today? Industrial demand for solar, EVs, and semiconductors is at all-time highs and growing. The supply deficit is in its 6th consecutive year. Investment demand is increasing but hasn't reached mania levels yet. We're not seeing margin buying at pawn shops. The current setup looks far more like September 2010 than April 2011. Now let me show you how these three components, mining investment, industrial demand, and investor allocation, create a self-reinforcing cycle above $80. Silver crosses $80. Mining companies approve development budgets for projects that weren't economic at $60. Those companies begin hedging future production by buying silver forwards, creating near-term demand. Industrial manufacturers see price at $80 and accelerate procurement to physical inventory to lock in current prices before they go higher. Solar panel manufacturers especially begin stockpiling 6 to 12 months of silver inventory instead of the normal 2-3 months. This removes metal from available supply. Institutional investors see 90-day outperformance and begin allocation increases. ETF buying and industrial stockpiling drain COMEX registered inventory further. Coverage ratios tighten. Higher spot prices validate the mining investment decisions made in stage 1, encouraging additional project approvals. They also validate the loop feeds on itself. Each stage reinforces the others. This loop is very difficult to break once it starts because it's based on rational decisions by independent actors, not coordinated manipulation. Mining companies rationally invest in projects economic at $80. Manufacturers rationally stockpile before prices rise further. Investors rationally allocate to outperforming assets. What breaks the loop? Only 3 things. Severe global recession that collapses industrial demand faster than investment demand can compensate major supply discovery that credibly promises 200+ million ounces of new annual production within 24 months. Hasn't happened. Government intervention, imposing price controls or export restrictions that fragment the market. Absent to one of those 3, the reflexive loop continues until silver reaches a price where substitution becomes economically favorable across enough applications to materially reduce industrial demand. Based on current solar panel economics, that substitution threshold is somewhere above $120, possibly above $150. We're at $80. The loop just started. Let me give you what credible analysts are saying about what $80 silver means structurally. Peter Krauth, silver analyst and author of The Great Silver Bull, stated in a recent interview that $80 represents the psychological and technical level where silver transitions from a commodity in recovery to a commodity in structural shortage pricing mode. His target for this cycle is $140, $160 based on historical supply deficit resolution patterns. Steve Penny of Golden State Mint, one of the largest silver product manufacturers in North America, reported in late April that wholesale demand at $80 is actually higher than it was at $65, noting that buyers aren't waiting for pullbacks anymore because they expect $100 before year end. That shift in buyer behavior, buying into strength rather than waiting for weakness, is a hallmark of structural bull markets. Rick Rule, legendary resource investor, commented that $80 silver brings 400 silver projects into economic viability globally, which will create an exploration and development boom that paradoxically supports higher prices in the near term while building supply for 2030, 2032. That's exactly the dynamic I outlined earlier. The supply response is delayed, creating a near-term investment boom that adds to demand. Institutional research from BMO Capital Markets published May 1st projects silver reaching $95, $105 by Q4 2026, based on sustained industrial demand growth of 18 to 10% annually and continued investment inflows as silver crosses mainstream allocation thresholds. The language there is critical. Crosses mainstream allocation thresholds. They're identifying the same institutional psychology shift I described. Let me give you the framework for monitoring whether this holds or breaks. Indicators that suggest $80 holds and moves higher. COMEX inventory continues declining. If registered inventory falls below 25 million ounces, delivery concerns intensify. Solar installation data remains strong. If Q2 2026 global installations come in at 120 plus gigawatts, industrial demand is confirmed. Mining company CapEx announcements increase. Watch for major miners announcing project approvals with silver price assumptions above $70. ETF inflows remain positive. If SLV and PSLV see net inflows for 8+ consecutive weeks, institutional positioning is building. Shanghai premium stays elevated. If the east-west arbitrage gap remains above $8, $10, physical markets are tight. Indicators that suggest $80 fails and corrects, COMEX inventory stabilizes or increases. If scrap supply ramps up significantly and registered inventory rises back above 35 million ounces, physical pressure eases. Major solar manufacturer announces substitution program. If a top 5 panel maker commits to copper paste or alternative technology, industrial demand trajectory changes. Institutional redemptions from silver ETFs. If SLV sees 4+ consecutive weeks of net outflows, momentum capital is exiting. Recession indicators spike. If unemployment rises 2+ percentage points or manufacturing PMI falls below 45, industrial demand concern becomes real. Dollar rallies 5%+ on flight to safety flows. If DXY moves above 105, 107, dollar-denominated commodity prices face headwinds. Monitor those. They'll tell you whether the structural story is intact or breaking. If you're holding physical silver, understand you're holding an asset that just crossed a threshold that changes mining investment, industrial procurement, and institutional allocation behavior for the next 18-24 months minimum. Short-term volatility, $5, $8 pullbacks, are noise against that structural backdrop. $80 to $74 feels significant on a daily chart. Against a target range of $110, $140 based on institutional forecasts and historical precedent, it's a 7% wiggle. Don't let the noise shake conviction in the structure. If you're considering entry, recognize that waiting for confirmation that $80 will hold permanently means waiting until silver is at $95 and the confirmation is obvious. At that point, you've traded certainty for a 19% foregone gain. The edge in commodities comes from positioning when the data supports the thesis, but consensus hasn't formed yet. The data supports it. COMEX inventories declining, Shanghai premiums elevated, industrial demand growing, institutional allocation shifting. Consensus hasn't formed yet. That gap is your opportunity. For those looking at mining equities, understand that at $80 silver, primary silver miners with AISC below $20 are generating 75% + gross margins. Those margins fund dividends, buybacks, and exploration that aren't reflected in current equity valuations, priced for $65, $70 silver. The disconnect between spot silver at $80 and miner valuations at $70 is a structural arbitrage opportunity. Do your research on balance sheets, jurisdiction, management, but recognize the setup is favorable. Here's what I want you to remember. $80 silver isn't just a price level, it's a threshold that changes 3 structural components of the market simultaneously. It makes 340 previously uneconomic silver deposits profitable to develop, triggering a mining investment. It creates a paradox in industrial demand where the largest consuming application, solar panels, and it triggers institutional allocation model reviews that shift silver from fringe alternative to mainstream. These aren't speculative theories. They're documented behavioral patterns from mining companies, manufacturers, and institutional investors when the last time silver crossed a comparable threshold was. This isn't a prediction that history repeats exactly. It's an silver at $80.34 this morning isn't a market that's priced in these structural shifts. It's a market that just triggered them. The mining investment decisions are being made right now. The industrial stockpiling is happening right now. The institutional allocation reviews are being scheduled right now. By the time those decisions become visible in production data, inventory reports, and capital flow disclosures, the market will have already moved to price them in. You're not late, but you're not early enough to wait for perfect confirmation either. Today is Monday, May 5th, 2026. Silver is at $80.34. 3 structural shifts just activated. Mining economics transformed. Industrial demand became. Most investors are finance monopoly here. If this framework changed how do you think $80 silver holds through June? I read every stack intelligently. Think structurally. Understand what this is finance.